Choosing the right online broker is one of the most important decisions any new investor can make. A broker is not just a colourful app on your phone. It is the platform responsible for holding your money, executing your trades, reporting your transactions, and providing the tools you use to build your long-term wealth. Unfortunately, many beginners choose a broker based on advertising, social media hype, or because their friends are using a particular app. In reality, the safest and most suitable broker for you might not be the one with the most aggressive marketing. In this video, we're going to break down how to choose a broker properly and responsibly, starting with universal principles that apply everywhere. Then we'll explore the differences between the European market and the US market, so whether you live in Europe or the United States, you'll know exactly what to look for and what to avoid. Let's get started. Before comparing platforms, it's crucial to understand what a broker actually does. A broker is a regulated financial institution that gives you access to the stock market. They execute your buy and sell orders, hold your assets, keep your cash safe, and provide the interface you use to manage your investments. Some brokers focus on long-term investing, others on day trading and speculation, and some offer a mix of both. Understanding the role of a broker helps you avoid choosing based solely on the appearance of the app or the popularity of the brand. Modern financial platforms invest huge amounts of money in advertising. Their goal is not to educate you, they want you to sign up as quickly as possible. They show smooth animations, friendly colours, and influencers talking about how simple it is to make money. But these ads don't highlight risks, fees, limitations, or the real level of customer support you'll receive. Many advertisements leave out important details, such as how spreads are charged, whether your orders are routed for profit, how fast withdrawals are processed, or whether the platform encourages high-risk products like options or CFDs. Following the hype is one of the biggest mistakes a beginner investor can make. Good investing starts with research, not marketing. One of the first things you should check is whether the broker is properly regulated in a trustworthy jurisdiction. Regulation determines how the company must manage your money, how it must store your assets, and how it must report its financial stability. Regulated brokers are required to keep your funds segregated from the company's operational accounts, participate in investor protection schemes, and comply with strict audits. On the other hand, unregulated or offshore brokers often operate without transparency, making it much easier for them to freeze your funds or disappear entirely. Before evaluating features or fees, confirm that the broker is regulated by a recognized financial authority. A growing trend in the industry is the promotion of zero-commission trading, but this does not mean trading is free. Many platforms charge foreign exchange fees when you buy assets in a different currency. Others apply wide spreads, which can quietly cost you more than a fixed commission would. Withdrawal fees, inactivity fees, deposit charges, and transfer fees may also apply. Certain US brokers rely heavily on payment for order flow, meaning they sell your orders to market makers for profit, which can affect the quality of your trade execution. What matters most is transparency. A broker that clearly explains how it makes money is generally safer than one that hides behind catchy promises. The usability of the platform plays a major role in your long-term experience. A good broker should have an interface that makes it easy to place orders, track your portfolio, read statements, and understand your holdings. Execution should be reliable, without frequent outages or delays during high volatility. Customer support is also essential. Many low-cost brokers cut corners here, and while everything works fine most of the time, When something finally goes wrong, such as a delayed withdrawal, a missing dividend, or a tax report error, you need access to real, competent support. The quality of assistance can be a defining factor for beginners. Regardless of where you live, taxes are a crucial part of investing. Your broker must provide clean, organized, and complete tax documents. These include transaction histories, dividend reports, withholding summaries, and annual statements. If a broker produces incomplete or confusing reports, you may face major difficulties during tax season. Choosing a platform with good reporting tools can save you time, money, and stress in the long run. If you're a European investor, you operate within a framework governed by some of the most secure and structured financial regulations in the world. European brokers are typically supervised under MiFID II, which is designed to increase transparency, protect client funds, and ensure fair trading practices. Regulators such as ESMA at the European level and national authorities like BaFin in Germany, AMF in France, CNMV in Spain, or SIPC in Cyprus enforce strict rules on brokers. This regulatory design helps ensure that European investors have strong protections, but it also means that product availability and leverage levels can differ from those in the US. European investors generally encounter three main categories of brokers. Traditional banks and national brokerage firms are usually the safest and most conservative option, offering stability but often at higher fees. Pan-European online brokers are widely popular because they offer low fees, modern interfaces, and access to international markets. Then there are CFD-focused trading platforms, which are not designed for long-term investing and often encourage speculative leverage trading. For beginners, it's important to distinguish between investing platforms and trading platforms, as the latter can expose you to significant risk if you're not careful. Depending on the country where your broker is licensed, your investments are covered by national investor compensation schemes. For example, Ireland's ICCL, Cyprus's ICF, and the UK's FSCS, for post-Brexit UK brokers, offer protection if a broker fails financially. These compensation limits typically range between $20,000 and $85,000. While these amounts may not cover very large portfolios, they significantly reduce the risk for beginners and medium-sized investors, especially when combined with segregated accounts and strong financial regulation. In Europe, cross-currency trading is extremely common because many investors buy US stocks. This means FX conversion fees are often unavoidable unless your broker supports multi-currency accounts. Some European countries apply additional taxes such as stamp duty in the UK or transaction taxes in Italy, France, and Spain. A good broker should display these charges clearly and handle the paperwork on your behalf. Beginners are often surprised by these extra costs if they are not prepared. Tax rules vary widely across European countries, which means you need a broker that provides detailed and accurate statements. Some brokers automatically apply correct withholding taxes on dividends, while others require manual reporting. Clear exportable statements in PDF or CSV format are invaluable. Many European investors regret choosing a broker based solely on low fees when they encounter difficulties preparing their tax filings later. The US market is regulated primarily by the SEC and FINRA, both of which set strong standards for investor protection and market integrity. US brokers generally offer excellent transparency and deep liquidity, but the environment is also more aggressive, with easier access to options, margin trading, and high-risk leveraged strategies. This makes careful broker selection even more important for beginners. One of the biggest advantages of American brokers is SIPC insurance, which protects up to $500,000 per customer, including up to $250,000 in cash. This coverage applies if a broker fails financially, not if the market goes down, but it provides extremely strong security for client assets. Many investors choose major U.S. brokers for this reason alone. American investors usually choose between three categories of brokers. Full-service firms such as Fidelity or Charles Schwab provide comprehensive research tools, excellent support, and strong long-term reliability. Discount brokers like Robinhood or Webull offer free trading but often promote high-risk strategies and gamified interfaces. Hybrid brokers such as TD Ameritrade or E-Trade offer the best balance of features, combining research tools with competitive fees. Each category has its advantages, but beginners should focus on platforms that encourage disciplined, long-term investing rather than speculation. U.S. brokers were the first to introduce zero-commission trading, but this business model relies heavily on payment for order flow. In simple terms, the broker sells your trade orders to a market maker, who then executes them. This is not illegal, but it can influence execution quality. Some brokers offer better routing than others, so reading disclosures is essential. What appears free sometimes comes with trade-offs that beginners don't notice until later. The U.S. investment environment is heavily influenced by social media, options trading, and a culture of fast speculation. Many platforms are designed to encourage frequent trading through notifications, animations, and easy access to leverage. For beginners, this can be dangerous. While the American market is one of the safest and most advanced in the world, it also requires discipline to avoid emotional and impulsive trading. Choosing the right broker is not a decision you should make based on ads, hype, or what your friends are using. The right platform affects everything: your safety, your fees, your tax obligations, your support experience, and your long-term investing success. Whether you live in Europe or the United States, the principles remain the same. Look for transparency, strong regulation, good reporting tools, and a platform that supports your long-term goals. Avoid platforms that push speculation and promises of easy money. If you take the time to research properly, you will be able to choose a broker with confidence and start your investing journey on the right foundation.